What's up guys, it's Chris here. In today's video, I'm going to take you through a bit of an update in the stock markets, what is happening recently in the world of investing, and spoiler alert, it's a lot. So we're going to see how this is going to affect your portfolio, and we'll also be checking in with my own investing portfolio to see how it's going. And lastly, I'll be telling you exactly why I decided to buy 9 different shares from across 3 different places in the world in just one day. So let's get started. Okay, so first let's jump right into the markets because there is a lot that has been happening in the last week and some of it is actually quite strange. So if you have been seeing some changes in your portfolio recently, then you're about to find out why. And if you find this kind of information valuable, please remember to click the like button on the video. So the major driver of the markets in the last 2 years, as we are all aware, is inflation and interest rates. There is nothing that has been more impactful on the market prices recently. So whenever there are statistics released or economic results, or lastly and most importantly, interest rate announcements, then people and investors take notice and the markets tend to move accordingly. And as you've probably seen, in the last 2 years, the markets have been tough. To put it simply, prices have been depressed. Now, that's not to say that there hasn't been growth. You can just quickly look at all the major indexes to see that they are all quite positive over the last year. South Africa has grown 17% in 1 year, the UK is up 9%, Australia is up 8%, America is up 19%, and Europe is up a crazy 25%. So those are the indexes, and there are reasons they are up. Mostly because of the tech stocks, which saw a jump in price because AI has become so popular and people anticipate tech being able to take advantage of it. Also because tech was severely down last year, so it's coming from a lower base. But what it means by saying prices are depressed is that their growth has been restricted. And depending which industry or company you have invested in, they may just be down altogether, which actually in some ways is an incredibly good thing, but we'll get into that later. So let's catch up on last week. Now, the way the world usually works is that the USA releases their interest rate decision first, and most of the time the world usually just follows the same thing. Not just to follow them, but because usually everyone faces similar situations, and after 11 interest rate increases since last year, it usually goes like this. If interest rates rise, it's bad and the markets go down. If interest rates stay the same, it's good and markets go up. And we haven't had it go down yet, but in the future that would be ideal. And that's because higher interest rates means companies pay more for their debt, which they all have, so costs go up and profit goes down. So it's pretty simple actually. Except this last week it was not so simple, because in a strange turn, the US Federal Reserve Bank announced they would be keeping rates the same, but the markets went down. So here's why. Jerome Powell, the chair of the Federal Reserve, said the rates would remain the same and that inflation had come down, which was a welcome development, which is all good news. But then he said something else. He said that the central bank would continue to raise interest rates if appropriate, as inflation remains too high. And he hinted that there would possibly, if not likely, be another interest hike or 2 in this year or next year before looking to pause rates for a while after that. So although it is positive news that the rates remain unchanged and that inflation is coming down, his simple act of saying there would likely be more to come has affected the markets, because investors look to the future, and if they know there might be more rate increases that will make it tougher for businesses, then it might as well affect the share prices now. So following this announcement from the USA, both the UK and South Africa subsequently paused their hikes as well and announced interest rates would stay the same. So that's why if you look at the 1-month graph for all these economies, they are down up to about 3%, except the United Kingdom, who received some better than expected economic data, with inflation down more than expected and their GDP growth up a bit more than expected, and some more lenient green policies, so they saw about 2% growth, and I saw that in my portfolio as well. So there you have it. That's what's been happening in the market recently. We have a rates pause, which is good, but the possibility of another hike in the future, which the markets don't like. Maybe I could have just said that. So how is that going to affect us, and what can we do about it? Well, firstly, like most of the major market indexes, you might have seen a decline in the last week or 2 in share prices, which is natural and normal given the news, and I saw it in my portfolio as well. Now, what tends to happen in the markets is very quickly the anticipated future price is factored into the markets. If we know it will rain tomorrow, we will bring an umbrella. So very quickly markets adjust down in the next few days, but very quickly the adjustment is made until the next bit of news. So if you are a long-term investor like I am, who tries to invest in good companies with long-term value and growth potential, then the general ups and downs won't matter too much. It's like a roller coaster which can get scary, but eventually get you to the place you want to be. You just need to stick with the ride, stay on course, and keep investing in good quality investments. And when you do that, you also see that these things can also bring opportunity. Okay, so now for the next part. What can we do about it? But before we get there, I just want to promote the Casual Cash Club, and if you haven't heard of it, it's a community we have over on Patreon where you can join for just $3, and it gives you immediate access to where I post my income breakdown at the end of every month, along with portfolio updates, all of my buys and sells, tips and tricks for investing, market news, and some spreadsheets that will help you track your financial retirement journey. So if you want to get access to all the 37 posts that's already there immediately, you can join the club in the link below. So now I can't tell you what to do, but I can tell you about what I look at in the market and why I chose to buy an additional 9 shares just last week. So to simplify my point, this is the S&P 500, an index of the 500 largest companies in the USA, also often referred to as the US market. Now in the last month, it is down by over 2%, but in the last 6 months, it's up by 9%. From January, it's up 13%, and 5 years, nearly 50%. And as you zoom out further, you get the full picture. And it's very much the same with the South Africa market and most others. Another example of a company of mine is Realty Income or Standard Bank. Now, when I talk about investing in solid companies or ETFs with good value and long-term share price growth, these are the types that I'm talking about, where they may go up and down with the headwinds of the market, but over the long term, they always tend to perform well. Because while nothing is certain, you can be pretty assured that if you keep investing and hold over the long term, you will make some great returns and be able to build wealth and freedom for yourself. So my strategy is to keep investing small amounts consistently and regularly, and growing my position in solid, valuable companies, as well as my passive income over time. Now, I don't ever gamble with the market. I don't try to time and predict where it will go and put all my money into it at one time, hoping it goes the way I think. But occasionally when the market is a bit down, I will add an extra top-up amount just to purchase in at a bit of a better and lower position. And that is for 2 reasons. The first is the simple principle of wanting to get the best price. If I believe a share price will be higher in the long term, then if it drops, it can be a good entry point to top up your holdings. Not to make a huge bet with a large amount of money, but to top up at a good price. And the second, which as you know is important to my portfolio, is dividends. Because when share prices go down, the dividend percentage goes up. So if a share is worth 100 Rand and pays 10 Rand dividends a year, that is 10% dividend yield. But if the same share goes to 80 Rand, then that same 10 Rand is now 12.5% dividend yield. And even if the share price grows to 200 Rand in the future, you will always have bought in with a slightly higher dividend yield and hopefully some share price growth as well. Now, I often top up my investments at the end of the month, but because of the recent news, I topped up a bit early, and like I said in the beginning of the video, I bought 9 shares across 3 regions. So let's take a look at them. My first top up was my 3 index funds in rands. This is the S&P 500, the FTSE 100 and the Satrix 40. If you've been on the channel, you know I add 100 Rand to these every month for nearly 2 years now as an experiment to see the value of dollar cost averaging, but they're also often my best performing investments. So as usual, I added 100 Rand to each of these, same as I do every month. Then the next was my UK or GBP portfolio. Here I topped up 2 of my index funds, which were the HSBC FTSE 100 and the iShares Eurostoxx 50. Now the difference of these is I'm investing in pounds, so it's currency diversification, but also the pound has appreciated by 18% to the Rand just this year, so that's an 18% return just on the currency as well. Then in my USD portfolio, here I also invested in US dollars, which appreciated by 5% currently this year to the Rand. And in my American portfolio, I topped up on 4 investments of mine. The first is the Vanguard S&P 500, which is like my South African version, but again, it's in dollars. then my Schwab US Dividend Equity ETF, which as you can guess is a dividend focused ETF with great long-term share growth as well. So like I said earlier, when markets are down, the dividend percentage goes up. So I really enjoy taking advantage of that. Then next is Simon Property Group, and if you want to talk about great dividends, this company is currently paying a nice 6.8% dividend a year, which is a bit more rare in the US markets. And if you want to look at long-term opportunities right now, property is one of those, because it is being battered by high interest rates, so its share price is depressed and dividends are higher. But if you want to hold for the longer term, at least 5 years or more, up to and past when interest rates have paused and come down, they are showing good value. Simon Property, for example, is right now trading at 45% below its fair value on Simply Wall Street. And the last share I topped up is Realty Income, a property company that pays monthly dividends. And a great example, as I showed earlier, of a company with great long-term share and dividend growth that is showing good value. Dividends are 6% a year and it's currently 50% below its fair value. Just this week I saw 3 articles about how it is a good value buy at the moment. So I've been happy to keep topping this one up for the long term, but knowing, like I said before, that there will be short-term pressure on the share price, but with a nice 6% income and monthly payments. So we'll hold this for at least 5 to 10 years, but hopefully a lifelong source of growth and income. But guys, that is it for today's video. I hope you enjoyed the market updates and some insight into why and how I invest for my own personal portfolio. If you found this valuable, please leave a like below. And if you're new, to subscribe to the channel for more. And a reminder that if you want some behind the scenes insight into my portfolio and buys and sells and the passive income it generates, you can check out the Casual Cash Club in the description. Let me know any questions, but otherwise I will see you guys next time, as always, on Casual Cash. Cheers.